Nilesh Shah, MD at Kotak AMC. Nilesh, morning. Thanks so much for joining in. Now, mutual fund expense ratio, which is currently at 2.5%, will be capped at 2.25%. How exactly will this affect the mutual fund industry, according to you?
So, one, this is a step in right direction, as mutual fund industry has gathered economies of scale, and the benefit of economies of scale need to be shared with our investors. We also must appreciate that SEBI has been pretty proactive in cutting expense ratios on mutual funds. So, for example, when GST was levied on distributor commission and other expenses, that burden was not passed on to consumers. And on 1.5% expense ratio at 18% GST, that's a reasonable number of more than 25 basis points. Second, we also had reduction in close-ended schemes expense ratio, and also, B15 became B30. So SEBI has been continuously bringing economies of scale benefits to investors, and now I think we need some amount of stability.
Right. Nilesh, so how have AUM slabs changed and its subsequent impact on profitability for the mutual funds? I mean, will this burden be shared by distributors? How much of it will be absorbed by mutual funds?
So effectively, earlier there were different slabs of 0 to 100 crore, 100 to 400 crore, and 400 to 700 crore, and so on and so forth. Now the slab has been relaxed a little bit, but overall expense ratio has come down from 2.5% to 2.25%, and the lowest range, which was 1.75%, has come down to 1.05%. So effectively, depending upon which slab your funds are in, you will see expense ratio coming down from, let's say, 3 basis points all the way up to 30 basis points. Now, some of this burden will be shared by distributor community. Some of this will be absorbed by the mutual funds, which will have an impact on their profitability undoubtedly. But clearly, now we are getting size benefit. We have to leverage technology to reduce our cost. So there will be some amount of cost saving, courtesy reduction in expenses. For example, SEBI has already permitted Go Green initiative, whereby we are moving from paper to digital solution. So using cost cutting, leveraging technology, passing some burden to distributor community, the hit on the AMCs will be manageable.
Is there room for a further cut in MF expense ratio? And some would argue that this essentially is a move which is at par with global averages or with global best practices.
Compared to global standards, Indian mutual funds are already cost effective. If we look at some of the India dedicated funds which are managed in UCITS market, which are one of the most competitive market in the world, clearly at the existing expense ratio, also Indian mutual funds are cost competitive vis-a-vis them. Their larger size funds expense ratio ranges from 1.7% to 2.05%. We were well within that range, and with this expenses reduction proposed, will become even more competitive. I think in terms of further rate cut, we'll have to look at bringing parity between various financial products. Today, investors have choice of investing in mutual funds as well as other financial products, and there should be parity in terms of cost, in terms of upfront incentive, and in terms of commission payable, so that one set of product should not be sold or should not be missold based on upfront incentive or commission payable. So unless until we bring parity in taxation structure, in cost, in commission, in upfront, across all financial products, it will be difficult to push mutual fund alone. The risk there is that if we just push mutual fund alone, then the distributors might start selling other financial products. Clearly, we don't want to go back to a situation where people start selling chit funds and Ponzi schemes rather than financially sound products like mutual funds.
Okay, Nilesh, great speaking with you. Thanks really for, helping us understand as to how exactly now mutual fund investments getting cheaper. What exactly does it mean for industry per se? What it means for investors and